Greetings. This is Gabriel Timmons here with GC Financial and our Better Wealth. We're hosting a seminar today from the concept and add asset. This book right here. So thank you for joining here. So I'm gonna go ahead and we're gonna go ahead and get started here. Mr. Dominique Rufran had a pleasure. Actually, we were together last week at a phenomenal 3-day summit in Nashville, Tennessee. Dominique is the president of Better Wealth, former athlete there, Atlanta Falcons. Though I'm not going to hold that against him because it's all about the Duval, the Jaguars there. He had definitely a short stint in the NFL. He got in the financial services, financial education industry, and personal development. A phenomenal leader. His background in leadership, coaching, strategic planning here, and that he's doing here. He helps people breaking free, legacy building. Dominique is committed, a family man. He's also just had a little baby there. Mr. Dominique Rufran, the floor is yours, sir. Thank you for joining us tonight.
Well, thank you, sir. Thank you. I appreciate it. I'm blessed to be here. I'm excited. Gabriel's talked you guys up quite a bit. You know, I'm just honestly blessed to be here and get this opportunity to spend the next 45 minutes to an hour with you guys. We'll see how long it takes. I don't think we have a real end date, but at the end, we're going to do a little Q&A. I'd love to get to meet some of you guys, be able to make a personal introduction, have you guys ask questions. And for some of you guys, this may be a concept you guys have never heard of. Some of you guys may have heard of this concept before, but what I'm hoping at the end of this is that I've provided some tangible value to you guys nonetheless. And so I think it's going to be an extremely powerful session. And I think personally that it's going to be worth your guys' time. So thank you guys for being here. And with that being said, let's go ahead and get started. So for you guys that are on this call, you guys have no idea who I am. So sometimes I think it's important that you guys just get a small little bit of rapport built, a little bit of connection, so you guys don't just be like, oh, who is this random guy that's talking to me that thinks he has the right to spend an hour with us without actually giving any rapport validation or anything along those lines. So with that being said, my name is Dom Rufran. Click. There you go. And my first life, like Gabriel was talking about, was all around this. It was football, football, football. I became obsessed with it since the age of 4. As early as I can remember, I knew I wanted to play in the NFL. And I pursued everything with my whole being. Ended up getting a Division I scholarship to University of Wyoming. Had a very successful career. I was top 10 receiver of all time. Got in the record books for a lot of things as well. Some of you guys are probably asking, hey, do you know Josh Allen? That's always the question that comes up all the time. Yes, Josh and I were good friends. We did go to school together. And so I am officially a Buffalo Bills fan. But at the time, I was an Atlanta Falcon fan. The reason being is because that's who I played for. As a Pokes fan, Falcons fan, you just have to rep your squad. Sounds like Gabriel has a Jacksonville Jaguar, thing, which is strange because they're terrible. And I don't want to get too into that because I think there's some of y'all that are from Florida, so I don't want to hurt any of y'all feelings. But hopefully, your guys' savior from CU shows up well. Otherwise, you're gonna have another unfortunate year. But with all that being said, that was my old past. That was who I was. A little bit about my new why. This picture here pointing up to the sky is really everything for me. That's my relationship with Christ. That's my foundation. That's my faith. I know not everybody shares that, but I do think it's important that just people do know that is where my heart's at. This middle picture here is when I was in Haiti, and I went there on a mission trip. We ended up going to a village and an orphanage, and we spent a few hours. It's like 6 hours on this soccer field. It was hot, 110 degrees, and you could just feel the heat. And what we did was we took 6 hours and just scraped rocks off the field, just scraping. And when the 6 hours was over, we scraped the entire field clean of rocks, and the kids instantly jumped on the field. They, you could see it in their face. They had joy, they had passion, they had excitement, and they just loved the game of soccer. They were just playing it. And I was like, why in the heck were these kids not playing beforehand? And someone was like, oh, the reason why they couldn't play and really why we did what we did is because they didn't have shoes. And if they would have jumped on the field, then what would have ended up happening is they would have scraped up their feet. And so what I have chosen to do with my life, and one of the purposes that I feel like I've been called to do, is I now want to take all the resources, education, people, everything that I know, and build something special where I can go to third world countries and build sports fields for kids. And so this allows me to take my past of football and my experience of all of the things that I learned from that, and then business of what I'm doing today, and then be able to combine the two and help kids, which I have a huge passion for. So that is a couple big whys for what I do on a constant basis, on a daily basis. Another why is my family. So I have my beautiful wife. We've been married now for almost 6 years, and two kids. Like Gabriel said, I just had a one not too long ago. He's 3 months old now, and then this front one is Malachi. He's a hoot, and he's essentially my best friend. He's 2.5 right now. He was born on Christmas, but true joy to life. Having kids definitely changed your life quite a bit, as some of you guys may know. And so now, where am I at? So I went from athlete to now being the president of Better Wealth. Excuse the now I am the president. I have no idea, what that means, but that's a typo. So I'm the president of Better Wealth. I run and operate, and essentially what we do is we're a financial education company that help people keep, grow, and protect their wealth. And so my goal for you guys today is to share with you some financial education. And that's my main number one goal, and be able to do it in a way that you guys can relate with, take away, and be able to apply into your life, hopefully. And if not, then I didn't do my job. So hopefully we'll be able to do that. And by the end of this, you'll be able to give some feedback on, hey, I have some questions, or that didn't help, or this is really great. And we'll be able to talk about how we can continue to move forward with some more education afterwards. So the reason why I put this book up here is, if you guys are in the financial space or money space, your headspace is, in assets and growth and just wanting to be better yourself from a financial perspective, there's a good chance that you've read this book. And this was the book that jump started my pathway to where I am at today. And the reason being is because Rich Dad, AKA Robert Kiyosaki's quote unquote really stepdad, but it was his friend's dad, became a mentor to him and really taught him how to essentially create generational wealth. And one of the things that he talked about was buying assets and avoid liabilities like the plague. Money in the pocket is an asset, money out of the pocket is a liability, right? And so what I then essentially said is, okay, what is the best way to do this, and how do I do it the most efficiently? So I went down this entire path of my career trying to learn from many people, different educators, different professionals, extremely smart people, people that have been in the industry financially for 30 plus years. I just went down this path of just growth, interviewing people, learning from them. And what I essentially learned was that there is a efficient way to do this entire scope of money that most people don't talk about. And that is one of the things that I want to do, is talk with you about. That is essentially cut off at the bottom. But the whole thing that I want to make sure that we get from a desired result today is share with you one tool that'll help you be more efficient with everything else you're doing in your financial portfolio. Okay. So this isn't the end all be all. This isn't going to solve all your problems. But what this will do is will help you be better with a big capital B. I like to say that because we are Better Wealth, be more efficient, and help you live more of an intentional life. And that's one of our missions here at Better Wealth, is to help people live more intentionally. And so the definition of efficiency, which I think is important to just define words so we all are on the same page, is the ability to avoid wasting materials, energy, efforts, money, and time in producing a desired result. Right. So what I see often when I see people's financial portfolios or talk with them, they have this financial junk drawer where you essentially ask them like, hey, what do you have going on in your life financially? Well, I have a little bit of debt here for my home. I have, this Roth IRA. I put money into my 401k because I get the company match. And then over here, I have a little bit of crypto, and I have like $2,000 in my savings, and I have credit card debt, and I also have. So then you just start hearing all these things, and it's like, okay, you have all these financial tools, but what are they doing for you? Are they helping you? Are they being more efficient for you? Are they allowing you to get to the desired result that you want in your life? So that's why it's super important that we start with our why. Where do we want to go? How do we get there? Let's find the most efficient way to do so. And this tool that I'm going to share with you is truly the foundational piece to help you be more efficient with everything else you're doing. And so with that being said, here's an example of efficiency, right? So there was the definition. Here's efficiency from an example perspective. So if I wanted to walk from Denver, which is where I live, all the way to Nicaragua, it would take me 957 hours. That would be a very, very long time. Hopefully I had some food, or I would obviously die. I think I would probably just die just off of sheer walking. It's not necessarily my favorite thing to do. And then that was 12 hours, 78 days straight of just walking, which is actually insane if you think. All right. If we were to drive, okay, it would essentially take you 60 hours, 5 days, 12 hours a day. And if we were to fly, it would take you less than a day, which would be 5 hours total, right? So it's very simple, but it's just an example of efficiency, right? I could go walk or I could fly, and flying is the pathway that will help me be more efficient, eliminates friction, and gets me there with a quicker result. and a better result at the end of the day. So with that being said, what is this tool that'll help us be more efficient? Well, if you haven't heard of this concept, become your own banker, this is a concept that we're going to talk about. And in this book, it talks about this concept to taking back more control of your life, the interest that you spend. And we have also came up with a coin that's called Giving Your Dollar More Than One Job, the and asset. So this is a book that we own the IP of it, we copyrighted it. And because you're here today, you are going to get a free copy of this as well. So at the very end of this, I have a slide that says email me at my email address. If you email me there, I'll give you a free copy, send it to you, and it's yours. You don't have to worry about even shipping anything along those lines. And so what we're going to do is we're going to talk about this book. We're going to talk about the concept in it foundationally and essentially what this asset is, the and asset. And at the bottom, it says the secret way to save and use your money at the same time. This is how we just talk about it conceptually of giving your dollars more than one job. And it'll make more sense as we continue to go through this. So who knows about this concept, right? You talk to your friends about it, they probably have never heard about it. You talk to your family about it, they probably never heard about it. But there are a select few of elites that do know about this concept. And there is obviously, probably the 1% of the world, not necessarily financially, but just educationally, that do know about this concept. And some of you guys may know about it and some of you may not. If you already know about it, great. You're going to continue to get more education that I think is going to help. And then for you that don't, this is going to be brand new and there's just an education curve that comes with it. But all of the presidents, they use it, they know about it, they use it as a powerful tool. Banks own it. Lots and lots of banks own it. They own billions and billions and billions of dollars of this asset, 12 plus billion, 19 plus billion, 22 plus billion, 3,200 plus banks own this asset because they understand how powerful it is. Corporations use it as well. They use it with their employees. They use it for their business activities. The list is endless when you start to get into the wealth education of the wealthy people that are using it, from corporations to individuals. All people that understand wealth, they understand this concept. Even Walt Disney, back in the day, used it to help him start Disneyland. And Ray Kroc also used it to help him get off the ground with McDonald's as well. And so there's even some more advanced strategies when it comes to this concept, which is like Roy Ball from Michigan. They used it to pay him, gave him like a $5 million salary per year using this concept. And then this is one of my favorite slides because it really talks about more of the mindset from an educational perspective and how there's two extremely wealthy families that were the more wealthiest families of all time back in the 18. You fast forward all the way to 1973, the Rockefellers, they are still one of the most wealthiest families of all time. And $60 billion of net worth still to their family. The Rockefeller or the Vanderbilts, unfortunately, not a single person of going from the richest family in the entire world to then a decade later, not even having a single person with $1 million. And it had everything to do with mindset, education, and how they use this tool with other tools. Because like I said, this isn't the end all be tool, but it was the foundational tool that allowed them to stack a generational wealth on top of it. And that's what the Rockefellers still do to this day. And the Vanderbilts, they didn't. And they squandered it. And now they're just a household name with no money to it. And so this concept allows you to give your dollar more than one job. And what I mean by that is you have yourself, right? You're the number one asset. If anybody says anything otherwise, then you are your number one asset. I will go to the grave to argue with them, right? That's why you ask any billionaire, they say, hey, if you were to lose it all, do you think you'd get it back? They say yes. Like if you dropped you in the middle of nowhere with no money, would you get it back? Yes. It's because it's all from the mindset. They pour in themselves from the education to skill set. And this is why you're here today, because you care about yourself, you care about your family, you care about your legacy. And this is why you want to learn, grow. And this asset is one of those things that can help you do so, right? Because it gives your dollar more than one job. All right. And so with that being said, here's just a couple ways high level that this asset can help you. It can protect your family. It can grow for a lifetime. You can control it. It can create future cash flow, help you save more. And so this is just a few common things. And again, what is it? If you guys didn't already know, you probably saw in the Roy Ball slide where it talked about the split dollar using life insurance. This is what it is. It's life insurance. Now, when you hear life insurance, this is what happens a lot of the times, right? People get angry. People get upset. People see or hear the word life insurance and they essentially run the other way because they think it's a scam. Or they hear that the man, the myth, the legend, Dave Ramsey himself, always talks about avoiding cash value whole life insurance policies. And so I have lots of empathy because I do think that Dave is very smart. I do think that he helps a lot of people, but I do think that he's uneducated in a lot of ways. And I do think that Dave can help a very specific few people. But when you want to take your wealth to another level and become like a Rockefeller, obviously nobody on this call probably ever become a Rockefeller, like just to be quite frank. But the idea from an educational perspective, operate like the Rockefellers do, operate like some of the wealthy, like Rob Kiyosaki, et cetera, those types of individuals do. They don't necessarily do the same things that Dave preaches. And if you actually listen to Dave, he says one thing, but he does a completely different thing. Dave talks about like staying out of debt. And he talks about building wealth through mutual funds. But if you look at how Dave has really built his wealth, it's not through mutual funds, it's from business, right? It's from cash flowing assets. And that's why sometimes I do think that we have really been brainwashed at the end of the day, which is here. This is what I wanted to add. So what if I did tell you there was a better way to essentially do this entire concept of life insurance that you did not know, that the wealthy do, that the wealthy are aware of, and that you in your mind may just think, hey, I've been told it's a scam, so I'm going to just leave it as that. It's just a death benefit protection for my family, and I have some term insurance, and I'm just going to leave it at that. What if you were told that because the banks, the institutions, they don't want you to know this? What if they said, hey, what if we teach them on commercials and in school and education, we teach them that the best way to do this is get a good job, go to school, work for a job for 20 plus years, put their money into a 401k, give us the control, right? Because what happens when you put your money into something like 401k, they now have control of your money to go invest into the other assets like business, like real estate, those types of things. And then banks, they do the same exact thing. They're not going out and putting their money into a 401k. They're not giving their money away to institutions. They're taking your dollars and they're going to do multiple things with their dollar. And so it's probably hard to see from here, from this perspective, but, and I said before 2023, what do banks do? What have they done? And the reason why I said before 2023 is interest rates were a lot different then. So when you start to go down a whole rabbit hole of interest rates, when interest rates were a lot lower, your deposits when it came to your savings accounts were a lot lower. So now you can get anywhere from probably from high yield savings account, 4% from your deposits. And then what they essentially do is they take those dollars and then they go invest it in other things like credit cards and mortgages and loans. They do those things at a higher rate than what it is they're giving you. So they give you, in this example, they give you 1%. They're like, hey, I want you to give us your money. Okay. Give us. So we trust them. We say, hey, everybody uses banks. So let's do that. So we give them their dollars. What they then do is they then take that dollar and they go invest it in multiple assets. Okay. They don't just take $1 and go give it to $1. They have something that's called fractional banking, where they essentially can take more money than they actually have on the books. Okay. And they can actually go lend out. So if they only have $1, they can actually go take $10 and they can actually go give it into multiple places. It's a sick law that they are able to do, but hey, they control the rules. We don't necessarily do it. Sometimes we have to abide by them, but what we can do is we just know the cheat codes to essentially how they operate and kind of work the same function and same system that they do, even though we're not able to operate on their level in the same way. So if I get 1% to them and then they go loan it out 4%, you think it's a 3% increase, but in reality it's actually 300% because they're using other people's money. It's not their own money, right? You gave them money and they're using that to go lend it out. So they're actually getting a higher rate of return than what it may actually seem like. And if you took 1% to 2%, that's actually doubling. So which is also why you can think about it conceptually, how we're getting 300%. All right. So with that being said, 3,900%. I apologize. I definitely made that mistake there. Okay, so let's talk about this life insurance in itself, right? People talk about life insurance, and again, we talked about it being a scam, and what they know about it is it's a scam, it's costs a lot, the death benefit, it's over expensive insurance, right? The rate of return is limited, and so I understand that, okay? And that's what Dave Ramsey talks about, and they're actually correct. I want to just start by that. When you hear that, people are correct, but with a caveat. You have to know how to design it, especially type of life insurance. Okay, so this is what we're going to talk about today. So in typical life insurance, you see the opposite. Okay, so right here you see the green arrow pointing up, which is maximizing our living benefits, which is the cash. And in this example, you see the down arrow minimizing the death benefit. Typical insurance, what you see that the Dave Ramseys of the world talk about, is the death benefit is extremely high okay? But you minimize the living benefits. So all we have is this protection for our family, but we don't have any living benefits for today. So what we're going to do is we're going to talk about these living benefits, how you can utilize these living benefits to make your dollars do the more than one job and have efficiency work for you. And so with that being said, this is a specially designed, AKA the and asset. And if you hear the and asset, just think of special designed life insurance. Okay, specially designed life insurance. It gives you higher the cash value, lots of liquidity, more flexibility, less commissions to the agent. And I think this slide here that I skip past really quickly is the complete opposite of typical whole life. Okay, so if we use the words typical, this is kind of the things that you hear about. It's expensive, you get no cash value, not flexible, which means premiums are mandatory, and the rate of return is extremely low. And this is what Dave Ramsey talks about on a complete, consistent basis. But what we're talking about today is we're talking about the special design and asset that the wealthy use that you can also utilize, and how we can make your financial portfolio more efficient to help you get to the desired result that you're looking for. And so what I always like to do is compare it to a Swiss Army knife of financial products, is because if you look at, let's just say, the stock market's great from a standpoint of just growth. Okay, it's got one thing going for it. Okay, so it's like a blade, right? Then you have a savings account. Okay, the savings account may be this tiny blade where it's like, okay, it's liquid, I can utilize it, and it only does one thing. The and asset is so powerful because this is where it becomes the Swiss Army knife of financial products, where you can have your dollar do multiple things. And we're going to talk about the use cases of how this can be used, but I want you to think about this conceptually. And this is why we call it the and asset. Okay, too often we talk about, should I put my money into real estate or life insurance? Should I put my money into real estate or the stock market? In this instance, we don't have to choose. The way we think about this is we put money into life insurance, and we get to use that same dollar, giving you multiple jobs, to go and invest into real estate, to go invest in the stock market, to go invest into our business, to go invest in ourselves, while we're all getting the same benefits and the policy is also growing at the same time. And if you're hearing that right now, you're probably like, what in the world is he talking about? And if this is your first time, I understand, I have empathy. People will go 6 months of watching YouTube videos on our YouTube channels to learn this stuff and get educated. An entire year of interviewing very successful people, scratching my head, trying to figure this out. Like, is this real? This seems too good to be true. How does this really work? To essentially figure out the truth behind this concept. And so I completely have empathy. We're here to help. The book will help. Hopefully the rest of this presentation helps. At the end, we'll be able to answer any questions that you guys do have. And this will just be one of the things that you have to keep learning, keep educating yourself around. And so I really like to start from a benefit perspective with this quote: compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. We coined it to Albert Einstein, but I think at the end of the day, we actually don't really know. But we do know, obviously, the power of compounding interest, and that if you do understand it, it can be a powerful asset for something that you have. So with that being said, let's just talk about compounding a little bit and what I mean by this. So you have obviously the amount of money that you put into it, right? It's a couple functions with the interest rate that you get, and then you just have time, okay? So you have these three functions when we talk about compounding interest. And when we talk about compounding interest, we start to talk about, well, compared to what assets? Do we start to talk about compounding interest in the growth rate compared to real estate? Do we talk about compounding interest and the growth rate compared to our 401k? And this is what, if we're comparing it to a 401k, is how compounding interest differs. Okay? And this is where I think conceptually, if you can grasp this one slide here, it'll change everything about how you see a 401k versus life insurance and the way that they can be utilized. So you have one line, okay? You have the green line, which is compounding interest. Usually what happens in a 401k, you usually put your money into this account for 20, 30 plus years. And then when you get to a certain age, you essentially retire, right? And this is essentially the amount of money that you have. But when you're ready to retire, what ends up happening when you start utilizing the money? Well, your account goes down. And heaven forbid that you start to get into a place where the market crashes. You do have to pay taxes when you get to that point in time, right? So you start to have all these eroding factors to it. And now your pot of money starts to slowly go down. It dwindles, right? And the best part of compounding interest is at the very, very end. So when I'm 65, I don't want to kill the compounding interest, because that's when the most significant interest happens. All at the very beginning, you get the least amount of the growth that happens. And so you're missing out on this whole green section by putting into something like a 401k. Now, this is where it differs, okay, from the life insurance to, okay, that green line that you see, the life insurance never stops compounding ever, even when you're utilizing it. And so this is where the concept becomes kind of, how does this work? But if we can understand this and kind of start here conceptually and realize, okay, two functionalities, okay, it grows. When I utilize it, the money drops. Life insurance, it grows. And when I utilize it, it continues to keep growing and keep compounding indefinitely, even while I'm utilizing it. And this is the power of compounding interest with something like life insurance. And we'll talk a little bit more about the collateralized loan piece of it and how this is actually possible. And so here's a slide that I really like to just show, because I do think that there are people on this slide or on this call that may have one of these buckets. You definitely have a savings account. You may have a 401k, IRA, a Roth IRA, and this gives you some of the comparisons between the two. Between the four. Right? Safe, easily accessible, competitive growth, leverageable guarantees. You can read through all of them, right? And you can see that the life insurance, it has green from all of these benefits. Okay. And that's the reason why I do really enjoy it. I do enjoy that it has many, many benefits that attach to it, right? It does have creditor protection, tax-free growth, tax-free use. It has a death benefit, right? None of these have a lot of those. Like you look at the red side for 401k, the Roth IRA, they obviously have competitive growth because of the stock market. There are some creditor protections in there. There are some tax deductions in that come with it as well. And then the savings account, at the end of the day, it's just safe. It's liquid. There's obviously no growth in it. You can contribute as much as you want. And that's the other thing that I really enjoy about life insurance and why the wealthy use it. In your 401k, depending on your age, you're close to limited to around like 20K of what you contribute per year. Your Roth IRA, you're close to like 8 grand per year, depending on your age. Life insurance, there really is no limit at the end of the day of how much we can contribute to it. That is with a caveat, but it's usually close to about 25% of one's annual income. So if you have 100 grand per year, you can probably think about putting 25 per K per year. But if your income was continued to be unlimited, or you had assets and net worth that could contribute more, well, then you could do more, right? Even in these other assets, you're limited by the government on how much they allow you to contribute. And also, in a 401k and IRA, they force you to take distributions at a certain age as well, right? 72 and a half, all right, 401k, they say, hey, you got to take your required minimum distributions. Life insurance, there's none of that. You can keep it safe, protected, continue to grow for the rest of your life. It's because they want their money, right? Uncle Sam comes for the rescue and says, hey, it's time to pay up, all right? You're essentially going into the bed with the government when you choose to put your money into the 401k, IRA, those types of things. Now, I'm not saying that the 401k, IRA, those types of things are not good from a 100% use case. I like to look at all financial tools from an agnostic perspective. Where do you want to go? How do we get there? What financial tool will help you get there the most? Right? And a lot of the times for people, life insurance happens to be that one tool that becomes very beneficial for them because they have a family, they want the tax benefits, they don't want to be in bed with Uncle Sam, they want to invest in assets, they want to invest in themselves, they want cash flow, right? And again, when you're able to get to a stage of life where you have options, that's when you become free. When you become financially free and free from life is when you have options. Your 401k, those types of things, they don't give you options. You can only use it for really one use case, and that's it. This is where life insurance becomes an incredible asset. So here's the idea between thank you. I'm going to talk about compounding versus control. Okay. So this is where I was referring to the whole compounding of a 401k and life insurance. Okay. We all understand there's compounding there, but what you end up doing most of the time when it comes to assets is you can have one that compounds like a 401k, but you lose control. The 401k 59 and a half, right? You can't access it. You can't touch it until you get to that age, right? And then when you get to that age, you now have to pay taxes at the end of it as well. So the control piece is super important. Imagine a world, let's just say 2026 happens, and this is a prediction that I think could likely happen, where the world essentially goes into a massive recession. Stock market goes down, assets become cheap, they're on premium. You want to buy something, but you can't. Why? Because they're tied up in a 401k or they're tied up in an account that you don't have access to. So control becomes a super, super important piece to the compounding. How do we get something that allows us to grow, but also have access to and liquidity? That's why a savings account is great, because I can use that right away for something, but then it limits the amount of compounding you can get in it. So how do we get both? And that's where life insurance comes into play, right? It's like, what if we could get both? And that's where people don't talk about is the concept of getting both. They usually are only talking about one or the other. So control, super important. When life insurance is set up and used properly, you can access your money through a collateralized loan while your money continues to grow. And this is how I talked about that curve where it keeps growing. And even when you get 65 and you start to utilize it, it continues to grow. We are not actually taking a withdrawal from this account. So think of it this way, right? And I'll talk more about the whole line of credit concept, but conceptually, when you have money and you put it in a bank, you have $100. You take your money out, you now no longer have $100. You go use it, it's gone. Okay, you take your money out, you utilize it, it's gone. In life insurance, we don't actually take the money out. We leave it there. Okay, we'll just leave it there. It continues to grow and compound, but then we get a loan against it, and the life insurance company gives us money, their money. So we're actually utilizing their money. This is how you use other people's money. We leverage their dollars, right, to then go buy other assets to increase cash flow while our dollars are still staying there. So our dollars are still growing and compounding while we now leverage to use it. This concept happens the same. We're going to talk about some other assets that do this. This happens the same way when you talk about like billionaires, they have stock options. They're not selling their stock options, right? Think about Elon Musk. What did he do? Well, he essentially put his, Tesla up for collateral to buy Twitter, right? He didn't actually have $45 billion of actual cash to go pay for it. He just put it up, stock options as collateral to be able to then go ahead and buy it. This is what the wealthy do on pretty much majority of all other things. Why is that also important? This is how they avoid taxes. They don't pay taxes because they do this concept. If Elon Musk were to like, okay, I'm going to sell my Tesla and then go buy Twitter, he'd have this massive tax bill, right? That's why the wealthy, they do things a little bit differently. That he did things in the most efficient way. Use a collateralized loan. Now his Tesla stock is still there. It's growing, right? And he actually has Twitter. So now he has two assets that are producing cash flow, and he's able to get them tax advantage, right? So this is the secrets that the wealthy use that we can utilize on a very small scale. So I just talked about it. Really the concepts of the tax advantages piece. When we utilize this, we don't pay any taxes on it. When we set it up and utilize it in the right way. And the other cool part too, is if you guys didn't already know this, the death benefit, when it's passed down to the next generation, your kids, grandkids, charity, anybody in life that you find value of, that also goes to them tax-free. So you're now providing even more tax advantages to be able to utilize for the next generation as well. And this right here is how the Rockefellers were able to outlast the Vanderbilts by using this tool. They use life insurance, and they put life insurance on every single person that was born. So one person started with it, the dad. The dad then put it on his kid. When the dad died, that death benefit then went into a trust. That trust then can be utilized for buying other assets. Now, when this kid grows up and he dies, the death benefit then goes back and replenishes the trust. And then when the kid grows up and has a kid, he puts life insurance on his kid. So every person that dies essentially replenishes the trust. And every person in the family now becomes an asset. And this is how the wealthy keep, control, and utilize more of their money by utilizing these types of tools such as life insurance and trusts. Super, super powerful concept. Understanding this can definitely be a game changer when you utilize it properly. All right, so here's some key caveats when it comes to this concept, and it's important, okay? You can't just use any life insurance company. You can't just use any contract. This is why the Dave Ramsey's of the world talk about this as being a scam, because there are scams. There are scam companies. I don't want to call them scam companies. There are companies that do not maximize the efficiency of this. So if you have whole life insurance with a mutual company, that's what you want. If you have it with a stock company, that is what you don't want. Okay, so think of a stock company as a company where they're in the S&P 500. They pay dividends to their stockholders, right? And also think of companies that aren't very advantageous for this concept as well, as like home and auto companies where they have a lot of liability when it comes to that concept. So those are kind of where you'd want to steer away from. You want to use a company that specializes in this concept and that they pay dividends to you by being a mutual. So that's the difference between mutual and stock. When you have a life insurance policy with a mutual company, they actually pay dividends back to you, which actually expedites this process and supersizes your cash flow. Ratings, we want them to be strong financially. It's very rare that a life insurance company goes under, but all of them that we've used, they've been around for 100 plus years. They pay dividends every single year, guarantees that are built into this. And so you have to have this specialized contract, specialized company, and designed a specific way for this concept to work. And so when we start talking about the specialized company, specialized designs, I'm just going to show you guys this example of the left versus the right side. And I think this is a very powerful concept. And when we start talking about typical that the Dave Ramsey's talk about versus the overfunded and asset that I'm talking about here today that the wealthy use. Okay, so look at the left side. The left side is the typical. Okay, your first year, you have $0 in cash value. There's this left side here that talks about total cash value. And you see the first year there's zero. You can come grab them. Yeah. This left side has zero. The second year there's zero. And then what ends up happening is he's now getting old enough to where he can open doors. So that's a fun stage of life. Amazing. Thank you for your grace there. All right. So left side, typical traditional whole life insurance. First year, zero cash value. Second year, zero cash value. But look at the death benefit. The death benefit is almost $4 million. The third year, okay, you finally have some money, right? And look at the total cash value of $25,000, and you've contributed $150,000, right? So if I ever have an asset that I want to utilize to make my life more efficient, to go buy other assets and utilize while I'm alive, this is the definition of insanity of talking about death to my finances, right? And so I have massive empathy when I hear people like Dave Ramsey and people talk about that whole life insurance is a scam, because this is what it is. And what comes with this left side is the agent gets paid a lot of money. Okay, so in this left side, the agent will get paid almost like 50 grand for setting something like this up on the left side. On the right side, what you see is that the first year, instead of there being zero, you have almost $40,000 of cash value. So that's 80% of the total money you've contributed. But you see the death benefit, it's a whole lot different. It goes from 4 million to 1.3 million. And then at the same year that we were talking about in year three, there's 132,000 versus only $25,000. On this left side, on this right side, the agent will probably only get paid close to maybe like 7 grand. So there's a difference between the left side getting paid 50 grand, on the right side getting paid close to 7 grand, because they're designed differently. But the left side doesn't max overfund a concept to allow the policyholder to utilize the cash. On the right side, it does allow the policyholder and consumer to maximize their gains, to maximize their efficiency, to go improve their wealth, and so on and so forth. So this is why the Dave Ramsey of the world also do talk about it being like life insurance agents are scammy, is because they can make a lot of money when it's designed this way. But the right side, when you do it properly, it definitely limits the commissions, but maximizing the cash value piece of it. So we're going to talk about 3 ways to make contributions to a policy. And this is where we're going to get into some designs that I think you guys will be able to see. Some more numbers and be like, oh, I didn't know this is how the numbers can look like, and some ways to do this. But disclaimer first, everything's going to vary, okay? It's going to depend on your age, your health, your gender, the design goals, and essentially like companies, all of that stuff, that those things do matter. And some of you may not qualify for for life insurance, to be just quite honest, right? You either may be too old or you may have health problems. That's also okay. There are ways to get life insurance on other people in your life that do matter. So you can get it on your kids, you can get it on your spouse, you can get it on business partners, just really anybody that has an insurable interest in your life. We can get insurance on. So there are workarounds that come with this if you don't qualify from an age or health perspective. But with that being said, this is also why it's important that you have to talk to somebody and have a meeting with them to like design it that's specific towards your goals, because the dollar amounts will change. And the numbers that I'm going to share with you, some may think they're high, some may think they're low. But a lot of times when I show numbers, people think that they're higher, and they're like, "Hey, can we see smaller numbers?" Just know in your mind conceptually, the numbers can be smaller. But I like to just show numbers that are round, even numbers that you can conceptually see it. So it's just kind of think about maybe what it could look like for you based off of your current cash flow and what money you have at this point in time. So with that being said, let's talk about the first way to contribute. The first way is what we call the cash flow strategy. Okay. And so what that means is you just contribute a specific amount every single year. So you see this far left column that says premium outlay, $100,000 every year. That's the cash flow strategy. You just contribute 100,000, 100,000, 100,000, 100,000. People always ask, like, how long do I have to contribute to these things for? Do I have to contribute them for indefinitely? Because the numbers here are showing for like 15 plus years. The max years that you have to contribute to something like this is 7. Okay, so just think about that as well. And there are other ways that we can design it to where you could shorten that as well. And you also do have flexibility. And what I mean by flexibility is in the traditional whole life that we talked about, you're required to pay this $100,000. And if you don't, the policy can lapse and the policy can cancel. The way that we can design it, the way that can be designed is that you can actually create a floor that your contribution has to be maybe $20,000, but your ceiling up to a certain amount, up to $100,000, you can contribute. Right, so there is flexibility within it as well. So that is an attractive concept for the way that you can design this as well, is from that perspective. And you can see that this strategy here, the liquidity in year 1, okay, is about 80%. So that's a very attractive, sexy cash value that is from a first year perspective. And then when you look at the break even point, again, this will vary per company, per age, et cetera. Within 5 years, you can get all of your money back. So imagine this world where you're contributing money to a policy, and then at 5 years, you now have essentially a free $3,700,000 death benefit, because you scroll all the way over and you can see on year year 5, if you look at the death benefit column on the far right, it evens to the 3,700,000. You now have access to every single dollar you ever contributed, and you have a free death benefit. Now compare that to something like term, where you pay a premium every single year, right? It's cheaper, a lot cheaper, right? And I say cheaper as you're contributing less dollars, but actually, in my opinion, it becomes more expensive because when you pay those premiums, you never get those dollars back ever. You just pay them and they're gone. And if you outlive it, which there's a high likelihood you do because these companies are smart and they know that your mortality is likely going to last longer than what you're essentially going to have the policy for, well, then you just lost that money. What this allows you to do is gain the money and the interest back on that. And this is where I talk about efficiency. This is how we can get more of our money back and to work better for us, is now we can cut costs such as term costs, right? And we now have a death benefit that we will guarantee to have for the rest of our life until we die. So in this case, at the very bottom, it's about $8.3 million. This individual can say, okay, I want to have this amount of money go to my church, this amount of money to go to my foundation, this amount of money to go to my family. And the person that had term insurance and they outlived it, they had no money to pass down. People didn't remember them because they had nothing to show for from a legacy perspective. So with that being said, I'm going to show you another strategy that's I like to call and put it on steroids. It's the cash flow strategy plus steroids gives you a strategy called the front load strategy. And this strategy is really good for real estate investors, for business owners, for people that have a large lump sum of money that's sitting around and then want to make ongoing contributions after. The reason why it's called front load is what we do is we supercharge it up front. Okay. We essentially take the $300,000 and we put it in year 1. And then after that, we make the premium payments smaller. We make them $50,000, $50,000, $50,000. Again, you can think of the smaller numbers if you'd like. We've had people that have front load $500,000, people that make $1 million contributions per year, all the way from people that and it could vary from the lower end for age, income. Kids policies are a lot smaller contributions. Depending on where somebody's at in life, their policy contributions are a lot smaller. So there's understanding across the board. And that's why it depends on like your goals. And you really have to sit down with somebody to really dial some of that in. But you can see that this is a really, really cool concept because what ends up happening is your increase in net cash value. So look at the 1, 2, 3, 4th column over. It says increase in cash value. Every year I put in 50 grand. So year 2, I put in 50 grand. The second year, it grows by 55,683. So now I'm making money every single year by $5,000 plus, $8,000 plus, $11,000. Like it's consistently growing year after year after year. And I have this permanent death benefit that's lasting for the rest of my life. And this cash value is dollars that we can utilize to go invest into other things like business and real estate, while this money actually stays here and stays put because it's being collateralized, and we use a loan against it to go use our dollars in other places. And so the cool part about this concept is you do get more liquidity up front. So it's 94% in year 1. And again, that may vary depending on your age and health and so on and so forth. And the break even, when I get all of my money back, it happens in year 4. So I put in 450 and I have 458. So then I have a permanent death benefit for free, essentially, while I have this supercharged policy that's growing, has all the benefits talked about, savings, protection, and we're going to talk more about them towards the end, some of the other benefits that it can be used for. And so this is the last one that I'll talk about from a contribution perspective. It's called the single pay. This is usually for older individuals. So if you're at the tail end of your life and you have like a large lump sum sitting around, you want to figure out like, how do I maximize this? Well, you can pay a large lump sum of money and you instantly have a death benefit of instant generational wealth transfer. This isn't for everybody. This is usually for like 1% of people. There are other strategies that could be more beneficial even for if you are older. But think about it. If you just have $1 million sitting in a bank, you're like, man, I would just want to pass this down to my family. Well, the most efficient way to do it would be to do something like this because you're going to have more than $1 million. And it also gets passed down tax-free as well. Okay. Technically, you can still utilize it, but usually people don't utilize the cash in this scenario, but you could, but that's usually not what the goal is for this scenario. All right. So now the question is how does this actually really work, right? So you see the numbers, you understand the wealth to use it, and you're trying to figure out like, how does this actually work, right? You talk about this collateralized loan, you see the cash going up, you see that there's a lot of liquidity, you talk about these benefits. And so here's the framework that I like to think about that may be more applicable to some of your guys' lives that you've maybe thought about or use on an everyday basis. Think of it like a line of credit if you're a business owner. That's really what I like to compare it to. Or think of it like a credit card if you use credit cards because it's line of credit, or a HELOC. All it is a line of credit. So your cash value, just replace cash value with line of credit. That is your maximum utilization that you have. Just now you have this line of credit that always grows, right? all the other most other line of credits, they don't grow. There's no guarantees. There's no death benefit protection. But think about it. If you have a line of credit, even for your credit card, you utilize it, you use it for whatever life purpose, and then you just pay it back, and then you can utilize that again. And that's the same thing. So in year 5, we have $500,000. You go buy an asset for $200,000. Your cash is still technically $500,000, so you're getting your interest rate at $500, but your access and limit ability to use from your line of credit is only $300,000 now, right? Because you use $200,000. So the next year it grows to $626,000, but you have $200,000 of an outstanding line of credit balance out there being utilized in an asset like real estate that's growing, that's compounding, that's getting tax advantages, that's working for you, that's enhancing your life, right? But your line of credit also increased by another 120,000 ish after making another contribution. So this is how you can consistently get your line of credit to increase, while then you're able to go buy more assets while this is happening tax-free basis. Essentially talked about the different types of lines of credit. Okay, some of you may be business owners. You may have a business line of credit. Some of you may have a HELOC because you are a homeowner, right? You guys have used your HELOC to make improvements on your home. You may have used your HELOC to go buy real estate. People don't really know this, but a lot of times you can actually leverage your brokerage account, right? They all have different use cases and the characteristics behind them, right? So a HELOC, I think it's a great tool, a great asset. The only thing that's downside is that people can freeze it at any point in time. Your HELOC may not grow because wherever you live, your asset price of your home may not go up. But if your asset price of your home goes up, that's great. Your line of credit increased, right? So that's kind of the same way from your line of credit increasing with your life insurance. It's just the growth is different. You have 4 to 5% guaranteed growth within the life insurance, and your HELOC, it just depends on the growth rate of your home. Credit cards, you can ask for a line of increase, right? But it doesn't compound. It's not getting compounding interest. And the credit card rates are close to 26%, 17 to 26%, depending on your credit score. And life insurance loan rates right now are right around 5 to 6%. So they also have the cheapest loan rates out there, period, in life insurance than any other account. Your brokerage account, you do have upside because, you can, any year it can get 20% because the stock market can grow. But if you have an outstanding loan and your account crashes 20% because, the stock market, went to a recession, now you may have to essentially, this line of credit may be seized. You may lose everything because you had margin calls. So it becomes more risky, and you have to be very professional and very sophisticated to use this in a very sophisticated way. Coolest part about life insurance is it's safe. It's not exposed to the market risk. It does compound. There is the death benefit. And as long as you make your premiums, you always have this for the rest of your life. And that's what makes this amazing. The lowest loan rates, competitive growth, the guarantees, it's super safe. It's not exposed. And you have a death benefit. You get the best of all the worlds all into the one product. And this is how we learn to make our dollars work better for us and be more efficient. So here's some use cases that I want to share with you, okay? So I think this is a great framework to think about it from a use case perspective. You have your money, you put it into the life insurance, and it becomes now your emergency fund. So a lot of times people put their emergency fund in their bank and they just let it sit there. That's fine because you want access and liquidity to do it. But what if we now had our emergency fund that was also gaining growth, right? That it can now compound for us and have our dollars give us more than one job. So this is a job. It can be an emergency fund for us. You would probably never want your 401k to be an emergency fund because of the penalties, the taxes, the ability to access it would be a very long time. And when you're even working there, sometimes you can't even utilize it because there's restrictions around it until you leave. And then everything above your emergency fund. So let's say you had $30,000 of cash value. As it grows above that $30,000, everything else becomes your opportunity fund. So now if I have $100,000, that $70,000 becomes your opportunity to go buy assets. The assets that you would purchase would be things like real estate, put money in the market if you want, if that's what your cup of tea. I'm actually huge into crypto. So I actually have policy loans where I take my money, borrow against it, and I go put it into crypto because I'm a huge fan of crypto. I know it. It's in my investor DNA from an understanding perspective. I've spent 7-8 years learning about it. We also have a business. We've used cash value for business purposes. I've also used it for real estate as well. I've used it for mobile home parks. So I've used it for all of these, except I've never actually put money into the actual stock market before. That's just not something that I believe in. And that's not necessarily good or bad. That's just me. So everybody's investor DNA is going to be different. There's other alternative investments that people are into. They may be into oil. They may be into gas. They may be into just anything that is important to them in their life that they understand. You would take this dollars that's in the cash value of life insurance, and you would then go borrow against it to then go put it into the opportunity fund while you have your emergency fund, while you have your death benefit protection, while it's growing and compounding, while it's safe and while it's protected. And the reason why I really like this is how the wealthy really get wealthy, is they sit on cash and they wait until a massive opportunity presents itself. So imagine in 2001, a 2008, COVID, people are sitting on cash, they can take advantage. But people that are always invested into things, they have to just be at the mercy of the market. When things crash, their account crashes. But what if you have this account that's growing actually while things are going on discount? So you have this life insurance policy that's compounding, it's conservative, it's growing. And then when the market tanks, boom, asset prices tank, boom, real estate tanks, boom. You now have this opportunity fund to borrow against it to go buy these assets. And then what ends up happening is in 2008 to 2013, the people that bought these assets in 2008, these things grew tremendously. Then they sold it. And then when you get the funds back, you then can pay your policy loan back off, and then you can wait again. And this is how you increase your wealth, increase your net worth, increase your assets, increase efficiency, have tax advantages. And this is the way that the wealthy think about it. All right, so this is a great use case from that perspective. Something else that I think if you're not maybe more of a real estate investor, a business owner, or something along those lines, this is just a great thing to have in retirement for future. Okay. It just gives you more options. At that point in time, let's say you're 65, 70, you have this cash value. You can now choose, what do I want to do with it? Do I want to utilize it for vacations? Great. Go do that. If you want to use it for lifestyle, great. If you want to buy more assets, great. There's a lot of things that I can do. And specifically for even college planning, I think it's incredible for your kids. Absolutely incredible. Because you have 529 plans that you put money into it and it grows, right? But what happens when you get to that stage? There's limitations around it. You now can only use it for trade schools. You now can only use it for college. If you don't, well, then there's penalties that are involved with that. With life insurance, it really trains your kid to not think about just college. It thinks about what they really want to do with their life, because it gives them options when they turn to a certain age. When they turn 18, 20, 25, you can gift this to them, and they can now go use that on a down payment on their business, a down payment on real estate. Imagine a world where your parents would have done that for you, where they would have given you a pot of money that said, hey, we spent the last 15 years together of me teaching you, and I said starting at the age of, let's say 5, the last 15 years, me teaching you about how money works. We've had this life insurance policy where we've been putting money into it every single year. You understand how it works. You understand business. You understand how taxes work. You understand how leverage, you understand these concepts of money. I'm now gifting you with this money to go utilize for a business, to go utilize for a down payment on a home, to start your ventures. Everybody would have loved that, and they would have been in a much better financial situation. But as parents, grandparents, sometimes we don't think that way. But when we do, this is how you learn. This is how you can pass down a true legacy to your family. It's by education and giving them the tools to succeed in that instance. And now they have options, and they're also protected for their family, right? Because there's a good chance that they're going to have a family someday as well. So it becomes an incredible plan for college. There's also something called the volatility buffer, which essentially says, hey, if you do have money in the market, okay, it's a great way to grow wealth, I think, to some degree or another, depending on who you are. What happens when the market tanks? Okay, this could happen when a kid's actually at 18 about to go to college. Let's say if they have 529, market cuts down and 30%, their college fund just dropped. Boom. That's unfortunate. You're about to retire. You're 65. The market cuts down 20%. Boom. You now have to keep working. That happened to a ton of people in 2008. For everybody that was around, you watched the 60 Minutes, and that was like the big thing. It's like, you see these older folks that are working at now Taco Bell or Walmart, and like, I have empathy for them, and my heart goes out to these people. But it's because they put all their money into giving it to the Fed and the corporations and into a 401k, and then it was time to retire, and then it got wiped out from underneath them, right? And now they have to keep worrying. They have to keep working. Now a volatility buffer, what it essentially says is, hey, even if the market does tank, instead of me utilizing the money from my investment accounts, I can now utilize the money from my life insurance and then let this recover, right? Let my market recover, and then I can start taking money from my investments instead. So it actually gives you more time to get everything to regroup and grow back again, because this asset has always been growing. It's always going to be there. It's always going to be safe. It's compounding. And this actually, it's called the power of two, where if you had to pick life insurance or the market and you put them separately, you will retire. You will have more years of retiring if you put them both together. And it's actually actuary science. There's been study after study after study that proves it, that if you have both of them, you actually can live longer, or you have your money last for you a lot longer. So it's actually very powerful tool, even if you're not necessarily like the mindset of like investor or business owner. It can be good for pretty much anybody at the end of the day. Protection and legacy, passed down to your family, obviously from death benefit perspective. But also, if you get sued, they can't touch it. Now, this with a caveat, depending on your state, there are limitations. So like I live in Colorado, it's $250,000 of protection of cash value that nobody can touch, even if I get sued or creditors try to come after me. And in states like Florida, there's unlimited protection. So even if you had $2 million of cash value, they can't come for it. It just is what it is. There are some states where it's really bad and some states that are amazing. And so we could also talk about your state and what that looks like. But for majority, there is some type of protection, which is great. All other assets, a lot of the times they are exposed to being sued. And essentially, that's really when it comes down to wealth planning. It comes down to how much money can I keep, not also just how much money can I grow. Here's the thing that I was just talking to you about from the exemption perspective of the state of Florida. Creditor protected there. It's a great state to have it. Chronic illness, accelerated death benefit. Here's actually a story that just happened to us. We had a woman that got her policy set up. She had it for 8 months. We just checked in with her. We said, hey, how are you doing? She's like, I'm not doing so great. I just found out I had cancer. And she's like, I'm not working right now and I'm going to have to cancel my policy. And we said, oh, that's sorry to hear that. We prayed for her, all those things. And what ended up happening is we said, hey, if you didn't know, actually you can use your death benefit to be utilized today to help cover your costs of cancer and living and medical care and some of those things. So she had like almost $1 million of death benefit for 8 months of premium payments. And so you talk about rates of return and efficiency and protection and quality of life. This policy, it won't happen for everybody, but in this one instance, allowed this woman to get a massive amount of money to be utilized otherwise that she wouldn't have had before. And she didn't even know that was possible and even know that it was until we let her know, like, hey, this is how you give your dollar more than one job. You now have your money that's growing, death benefit protection, money in case something like this happens. It's protected, right? This is where it becomes a secret weapon in your financial portfolio because it does many things for you. The waiver premium, it's if you get disabled, insurance company keep paying your policies, premiums. And so what I like to say and what I like to end with is this concept at the end of the day allows you to have your cake, okay, which allows you to eat your cake, utilize it while you're alive, have all these benefits, and to leave it to have a death benefit to pass down to the next generation. And the cool part about this is knowing that you have this in place to when you die, it gives you permission to spend down all of your assets while you're alive, knowing you have money to pass down to the next generation. If I have money in the market or real estate, whatever the case is, specifically, let's talk about the market. If I say I have $1 million, but I want to pass down money to my family too, I need to live. So it puts me in a tough bind. Do I spend down all my money or do I save and hoard it so I can pass it down? If you have life insurance, what this allows you to do is allows you to spend down every single dollar you have, every single dollar, take it to the grave, all of it, go to zero, knowing that you have money that's left over from a death benefit perspective to pass down from a legacy for you to be remembered by. And so with that being said, email me at dom@betterwealth.com and I will give you a free copy of the And Asset book. We'll go ahead and ship it to you. So it's just dom@betterwealth.com and we'll go ahead and take care of you from that perspective.
Awesome presentation, Dome. Thank you very much, man. Definitely informational, man. Definitely be able to help like us help people here. I've been utilizing this myself for about the last 5-6 years. You know, like I said, the video I did is definitely changed my life there and what we have there. So this concept, like I said, has been around for a while, and it works.
Amazing. Unlock features used by, let's see here. What is this chat function here that I see? Is that something that yes, I love lines of credit. Hey, storing emergency funds there. I love it for a line of credit perspective as well. Carlicia, it's a cool name. I love that. Where do you recommend storing emergency funds? I think a great place to start is storing it in a bank originally. The reason why is because it does give you super, super fast liquidity within like literally seconds. But once you get to a point where the policy started, you can then start distributing your bank funds to your life insurance, and your life insurance can become your new emergency savings. I do always say that having like maybe a month worth in the bank is always great because you just never know and you maybe need it right away. And you may have a roof that breaks or you need something quicker. I think that's always great. But majority, I'd say 80% of all of your emergency savings can definitely be in your life insurance policy. I definitely think that a high yield savings account, especially in today's world, is a great place to store capital because interest rates may not be as high as they are today. I mean, if you think about beforehand, interest rates were literally 0.1%. When I use the example of what the banks were giving us before, 0.1, 0.5%, are really cool ways to strategically put money into a high yield savings account, like a large lump sum, and then funnel that money into a life insurance policy as well. And that's another strategy that we didn't talk about today, but that does create optionality as well to have your dollars grow in one place and utilize for another place too. We missed your email. Okay. Email is, maybe I can just type it in here, dom@betterwealth.com. Dom@betterwealth.com. There, it should be in the chat. DOM. To name a few, what are some good mutual life insurance companies? I'm a business owner, by the way, for 10 years. Amazing. Absolutely amazing. This is a great question. Absolutely great question. So some top mutual carriers that this concept works amazing with is Penn Mutual, a great company, Mass Mutual, Guardian, New York Life, Lafayette Life Insurance. Those are some of a few examples. There's probably about only, I would say, be honest, about 10 companies that utilize this concept specifically with whole life insurance that you probably would want to work with. Outside of those 10 to 12, you probably don't fit the criteria of not being mutual, not specializing in this concept, not paying dividends, or they just haven't been around for long enough. So you have to be very specific and have a great relationship with these companies, which is another great question as well.
Dom, let me add something to that.
Yeah,
And the
yeah.
thing too, Carlicia, is that they have to be designed. If you call if you call Penn Mutual the companies that Dominique just said, they wouldn't know what to do. You have to be trained, and these have to be specially designed the way this works there. So I wanted.
That is very true. We've had people before try to do it themselves where they call in and say, hey, can you design a policy for me that is like this? The people that actually work for the company, they get confused. They're like, I have no idea what that is. Or they try, they don't know. There are some levers that you got to pull inside the software. And you do have to be very specialized to know how to do that. And it's cool that we actually, I would say, are some of the best literally in the world when it comes to designing these specifically for high cash value usage, that I don't think that there is another team or company on the planet that can design better than us. Maybe if they're an expert as well, they can design it just as good, but nobody can design it better because I think we have really mastered the design perspective. And we have a team as well. Like, so we have a team of underwriters, a team of people that help from a servicing perspective. We work with you for the rest of your life. So yeah, it's a great question. I mean, Gabriel, if you want to answer that, feel free to answer that.
Yes, I can. Yeah, definitely. Like you said, with Better Worth there, we got a team of people. We can definitely help you with that. That's not a problem there.
Yeah. So Carlicia, to answer your question as well, to add on top of that is Gabriel and I we've partnered together to be able to fulfill on this concept. And so we are essentially yin and yang, where we're essentially working hand in hand to making sure that anybody that wants a consultation, to talk to somebody, see a design for themselves, to be able to work with us, and Gabe is part of that, to get something like this set up for them and their family. So that's what you are for. Got it. Yep. Amazing. Yep, I'm interested. Amazing. Yeah. So if you are interested, on top of that, like if you, what's going to happen? Just full transparency. I'm just going to ask the question when you email me and I send you the book. We'll send you the book. I'm also going to ask if it's something that you'd want to do, is have a conversation with myself or somebody on the team to be able to just see if this concept makes sense for you and see what a policy can look like for you. Kind of go from there. So. Yeah, we just shoot me that email and we'll definitely we'll take care of you. Amazing. All right. Amazing. Love that. Love to hear that. Okay. Looking forward to meeting you. It's going to be great. Okay. Gabriel, any questions that you have? Anything that you like? Tom should have talked about this, or maybe he missed this, or want to mention something, or anything that, probably could go over?
I definitely appreciate time. I'm just gonna add a couple small things.
Yo.
And Dom said this in the presentation. I'm a country boy, so I like to have sayings that you can't put a round peg in a square hole. Everybody's situation different. So, like he's always said, these policies have to be designed specifically for you on what you're trying to accomplish. What we talked about is health. So if you're not healthy, I had some health challenges. But my policies, I was able to do things and structure it a certain way. So if you're not healthy or you have some health challenges, that's okay. Come to us. We can help you. We got a team of people. We know how to do this. We both are using these in our personal life and for business there. We eat from our own stove. So I just wanted to add that.
Amen. And what is something I'll add to that is there are some things that are out of your control circumstantially from a health perspective. And I am very empathetic to understand that. There's some things that you can't do otherwise to improve that. But what this concept and what we try to do here at Better Wealth is we really try to preach intentional living. And we actually believe that wealth isn't just money, right? Wealth is a combination of many things. It's of your finances, your resources, your relationships, your health. And your health is a big piece of that, right? If you don't have your health, you don't have anything. And so if you're not able to get this because of your health, sometimes it can be a wake up call of like, hey, like maybe we should take this part of your life a little bit more seriously, so that way we can actually have an abundant, be more wealthy, have more time with my kids, have more time with the grandkids, live longer, be happier, have more energy, right? It's just a small piece of it, right? So we usually are able to find a solution regardless, but it's just, I think, mindset wise, that comes down to the Rockefellers and how they end up being so successful by keeping money in the house, is because they just had the mindset of just like what true wealth looked like and not just like one piece of it. Okay, amazing. Well, if there's no other questions, if there's no other things to add, I think go give it one more shot, going once, going twice. All right, so I will look forward to talking to those that sent an email and send you a book and have a great conversation with you there. Yep, dom@betterwealth.com. Looking forward to it.
All right. Thank you very much. We definitely appreciate your time, Doma. We're looking forward. We'll be doing another one soon. So we'll be sending the links out there. So, but definitely, any questions there, you can email us also. Okay.
Amazing. All right, everybody. Have a great day. Talk to you soon.
Have a great night. Thank you.